In Chapter 12, we will be looking at the answer keys for 1224A, 26A, and 27A. So first, let's start with 1224A on page 674. We have Loisel and Randall formed a partnership March 15th. The partners agreed to contribute equal amounts of capital. You want to underline that. Loisel contributed her sole proprietorship's assets and liabilities as follows. So we have book values listed and current market value. On March 15th, in requirement 2, they want us to prepare a balance sheet immediately after the point the partnership is formed. Well, we would look at those prior journal entries we just made. You could set up T accounts. Those are the only assets, liabilities, and capital. There's no revenues and expenses at this point that the company will have. So the assets, the cash would be at $43,100. That's how much Randall put in. Accounts receivable would be the $10,400, inventory $30,000, prepaid expenses $2,700, and the store equipment $24,000. So the total assets in the business $110,200. Loisel also contributed a liability of $24,000, so the accounts payable is in the partnership now, and it's the liability of the partnership $24,000. And then each partner's equity will be shown. Loisel's capital balance of $43,100 and Randall capital $43,100. When we add those together, the total partner's equity is $86,200. So when we did sole proprietors, you only had one capital account. Well, when you have a partnership, you have more than one owner. So each partner has their own capital account. We add the accounts payable, the liabilities, to the equity to get total liabilities and partner's equity equal to total assets. So even in a partnership, assets have to equal liabilities plus equity. The major difference between the partnership and the sole proprietorship is the way we present capital. That's it, because there's more than one owner. In requirement 3, they want us to journalize the closing of the net income to the income summary and the distribution of that net income to the owner's capital accounts, and also the closing of the withdrawals account. And we already defined that the company made $79,000 in net income. 60% of that goes to Loisel. So 60% of $79,000 will be credited to Loisel's capital account. Randall will have the other 40%, $79,000 times 40% or $31,600. And then we would debit the income summary. Before, in a sole proprietorship, when you did closing journal entries, you debited income summary and credited one capital account, one owner. Now you have to distribute those profits. Same with withdrawals. When we're closing withdrawals and we have the withdrawals defined for us, Lozelle's withdrawals were $41,000 and each partner would have their own withdrawal account. We'll credit Lozelle withdrawals $41,000, debit her capital account, reduce it. She took that money out of the business already. Do the same thing with Randall. Credit his withdrawals account, debit his capital account. Okay, so that's just demonstrating how we allocate profits, how we close out withdrawals, and set up the partnership. So that was 1224A. In 1226A, moving along, we're going to admit a new partner. Admitting a new partner. This is on page 675. In this partnership, George, Murphy, and Lincoln, a partnership. They're considering admitting Thornton as a new partner. On July 31st, all the capital balances of the three existing partners and how they share profit and losses are below. We need to make journal entries under each of these independent situations. So let's look at requirement 1. Thornton, the new partner, pays Lincoln, one of the partners, directly for his partnership interest. Okay, so Thornton hands Lincoln $174,000. He doesn't hand the partnership any money. So this is a private purchase. What does the company do? They remove Lincoln as an owner by debiting his capital account for its balance and give Thornton that balance now and credit Thornton Capital $130,500. The partnership didn't receive any kind of assets here. So all they're doing is transferring the capital balance from the old partner to the new partner. It changes in requirement 2. Oh, and remember something with requirement 1. There were 3 partners before Thornton became a partner, and there's 3 partners after. In requirement 2, that's not going to be the case. Thornton gives the partnership $87,000 to acquire a 1/4 interest in the business. Now, in this case, he's a brand new partner. After he did all the This could change. Let's take a look at number 3. Now he gives $87,000 and only gets a 1/6 interest. We go through the same computations because there's the partnership's getting an asset. They're getting $87,000 cash. There's 3 partners before, now there's 4. Take the $261,000 capital balance, and we find it the same way as we did before on page One more time on page 675. You take the 43,500 from George plus Murphy's 87,000 plus Lincoln's 135,500. Add them all up. 261,000. Whenever that new partner or any partner puts money into the business, it always increases capital. Increase 87,000. So the total amount of partnership capital overall is 348,000. He agrees to take a 1/6 interest. So 1/6 of 348,000 is $58,000. So his balance in his capital account is only going to be 58,000. He's willing to give $87,000 in cash to the partnership and only have a capital balance of 58,000. If he left the partnership tomorrow, he can only take 58,000 with him. That's his balance in capital. Why would you do that? He really wants to be a partner in this partnership, and he knows the partnership will be profitable and he'll get that money back. And that's why people will do this. Now, what about that difference? Because we're going to debit cash 87,000, credit his capital account for only 58,000. We still have $29,000 that needs to go somewhere. Well, when this happens, when the new partner pays more than their interest, they're really bonusing extra money to the partners, to the other partners. So they're paying off the other partners, if you want to look at it that way. How much? In total, 29,000. We'll distribute that 29,000 based on their profit and loss ratio. So Capital George will go up by 20% of 29,000 or 5,800. Murphy's capital will go up by 25% of that $29,000 difference. And Lincoln's capital 55%. So they get that extra money put into their capital account that was given by Thornton. Pretty nice deal, huh? But Thornton said, hey, I want to be in the partnership. That's cool by me. And that's how that happens. The final requirement takes a different approach. He's still given 87,000, still before 3, now 4 partners, and he's getting 33% or a 1/3 interest. So the total capital balance in the partnership after he contributes that 87,000 is 348,000. How much of a capital balance is he asking, or is he going to get in this? A 1/3 or 116,000. Now, listen, he gave cash of 87,000 and the partnership gave him a capital balance of 116,000. If he left tomorrow, he could take 116,000 of the partnership's assets with them. Why would the partnership do this? They really, really want Thornton in their partnership. And they tell him, maybe this partnership is a law firm and he's a hot new lawyer that is going to make a lot of money. They want him in their partnership because if he's successful, they're successful. So they're willing to give up some of their capital balance right now because they know they'll make it up in the future. Okay, and then our final problem is what happens when we have a partner withdraw from the partnership? When they leave, what do we do? Okay, Ho, Kim, Ling, Oriental Design, partnership owned by 3 individuals. The partner shares profits and losses in the ratio of 30% to Ho, 40% to Kim, and 30% to Ling. At December 31st, 2018, this was their balance sheet. In requirement 3, the partnership agrees to pay Ho $65,000 for her book value in equity, which is only $35,000. Okay, why would they do that? Maybe they really want her out of there. We'll take a hit. We just want her gone. She's terrible. Okay, there's many different reasons, but think of it that way. So they're going to credit cash. They gave her 65 grand. Don't let the door hit you. Get out of here. Debit capital Ho. She's gone. There's only 2 partners left. They have to eat up that difference that they gave her. And so it's treated like they withdrew the money themselves. So we debit their capital account for their remaining profit and loss ratio that's still left. So if Kim gets a 40% profit, Ling gets a 30% profit, we could say, okay, so that's 40% plus 30%. You can look at it that way, is 70%. So 40 of the 70, so 4/7 of the 30,000 will be debited to Kim's capital, and then 3/7 of the $30,000 difference is debited to Ling's capital. Okay, and then in the final, Ho leaves taking only $25,000 for her book value. Maybe Ho says, I need to get out of this partnership. Just give me 25 grand. I don't want to be here anymore. I'll take the hit. They debit her capital account, 35,000, only 2 partners left. They only have to give her 25,000. So that she essentially is handing those other 2 partners that $10,000. She's saying, I don't want it. You guys keep it. So what do they do with it? On that same ratio basis, they increase their capital accounts accordingly. Okay, so withdrawals are very much a lot like admissions. You could bring a partner in, they can contribute more than you give them, bonusing the partners that are in there, or you can have them bring less in than you give them, and you're willing to give up some of your capital balance as the other partners. And the same with withdrawing from a partnership. Okay, so those were the problems I wanted to review for Chapter 12. If you have any questions, post them to the discussion board or email me.